Okay, for this chapter, chapter 21, this is actually a rather short chapter, and I don't want you to spend a great deal of time looking over the material, but I wanted to at least introduce it to you so that you had some idea of how the savings market and investment market works in this overall macroeconomy that we're starting to construct here. So one of the first things for this chapter then is starting to talk about the idea that the actual GDP can differ from the potential GDP. So the potential GDP is what emerges when we're on the production possibilities frontier. To the extent that we are below that most often, although we could be just temporarily above it for realistic purposes. But to the extent that we're below or above it, that would mean that the actual GDP then differs from the potential GDP. Hence, the business cycle. So when we looked at how we determine our potential GDP, obviously we're concerned about things like our amount of resources, our land, our labor, our capital. But we're also then looking at, more specifically, outside of just the number of people that we have, more specifically how that capital is created. Because that capital plays an integral role in giving us the production possibilities frontier and the potential GDP. So capital is incredibly important in this model. And to talk about how it's created, we need to talk about the savings market and the investment market. In the financial system, there's obviously a stock market, right? That would just be equities, firms issuing shares of ownership in return for money. Then there are bonds, where that would be like a typical lending relationship, not where you own any shares of ownership, rather you have a legal debt that is owed to you by the company. So we have equities, stocks, we have bonds, and these equities and bonds are then used to finance production, right? What we then start to talk about then is, because we're talking about bonds and equities, we need to talk about the interest rate. Now, in this overall structure here of our economy, we can actually talk about how investment looks if we start to graph it out. It actually depends on the interest rate R, the level of investment, right? If the interest rate is incredibly low, then the amount of investment is much higher. Then if it's very high, the amount of investment is much lower. Now, what is determining this interest rate? Now, this interest rate is dependent upon the amount of savings that's out there, the amount of demand for that savings. It's also determined by what your preferences are for having cash, so that would be your preferences for liquidity. It's also determined by risk. What are the chances that you're going to be able to pay that money back? I found this interesting. We talk about risk and the ability of someone to pay back the money as reflected in the interest rate. It's very interesting. If you look at like those payday websites, or this one that's really, really bad, one where they'll give you cash in 24 hours, you don't even have to have a job. Obviously, there's a very high risk that you may not pay that money back. And I think the interest rate is close to 100%. Interestingly, Wisconsin's actually one of the few states in the country, actually, that doesn't employ usury laws, which mean maximum interest rates. That basically you can get away with charging much higher interest. It's why the credit card companies locate in states where that's the case, like South Dakota. Other ones are like in Delaware, I believe, but most of the companies, credit card companies, actually have their headquarters in South Dakota, another state that doesn't employ maximum interest rates. Now, that was off topic completely. So when we look at this idea then of where does this money come from that's being lent out? It's going to be coming from savings. And that savings is going to have two components. It's going to have private savings and public savings. So the private saving is actually going to equal total income, which is Y, minus taxes. So this portion right here is now called our disposable income, minus consumption. So we save basically whatever we don't pay in taxes and what we don't consume. Now for public saving, that would be equal to the amount of revenue the government brings in, that would be taxes, minus government expenditures. When we add both of these things up, we get something known as national savings. Now this looks really complicated, but fortunately we can cross some things out. We can cross out our t's, which means, right, because this is a minus t, this is a plus t, we can get national savings to be simply y minus c minus g. Now, you'll notice that the interest rate plays no role in this amount of savings. So what this looks like now is that the savings is vertical, right, if we just say the quantity of savings here. If we add our interest rate or our investment levels to this, which are dependent, this is going to be completely vertical, our savings. This is going to be downward sloping. Their intersection determines the interest rate, essentially the price of borrowing capital. Now, the other part to, kind of as this chapter concludes here, what it's starting to lead into is a bit of a discussion of, how we actually going to model now the entire economy. And this chapter concludes with a bit of a discussion of how much more stable the economy has become. I would strongly encourage you, as I look at it here in the notes, the fourth page of the lecture notes. If you look at it, recessions have become somewhat shorter, but they've also become, more importantly, less frequent. And the argument that the textbook makes, as well as most economists, is that active involvement by economists, an active central bank, an active set of politicians that are trying to manage the economy has made things a bit more stable. A bigger topic that we're going to look at in many of the chapters that follow this. This is a rather short chapter. You can see I talked about it. There's only going to be one part to this chapter. So don't spend as much time studying this chapter as the other chapters. Okay, that concludes this rather short chapter.